Hey everyone, thanks for joining for the final session of the Waypoint Energy Live series. We can have a little bit more of an intimate session today, just kind of rounding out the last few days of the 10% share price discount, and we wanted to just make sure that we had a culmination of all the information that we've put out by hosting just an open forum Q&A. We're going to be talking about some little nuances within the deal. We'll talk about the subscription documents. Brittany's got the sub agreements open, and we'll point out a few things. But otherwise, it'll just kind of be an open forum Q&A. Mark is just coming home from a conference in Louisiana. And he's only got about the first 20 minutes. With that, I'll turn it over to you, Mark, first, just to sort of give an update on what you're seeing and how the we did an off the record call yesterday, which was fantastic. We had a great showing for that. I think a few of you that are on here today were on yesterday or the week before, but we went in detail over the Mark's process and what we've got about $300 million in well packages that are on the short list. So, Mark, I'll turn it over to you for a little update.
Yeah, thanks, Nate. That's a good update. I'm at a Louisiana Energy Conference, talking to a lot of people that are doing business in North Louisiana. So, had a good conference so far. About to come back. Just kind of an update on that. I attend 2 to 3 events a week, most of them in Houston, but occasionally out of town just to get the word out, network with other operators and other investors as well, just to tell them what we're doing. So far, so good. We've, like Tate said, got about $300 million of deal flow that came in. We've bid on a few properties. Right now, the only property that looks like we've won is a property in North Louisiana, and we're excited about it. The operator is Comstock, and so we've just now finished signing all the documents with them. And as soon as we take a look next week and see how much additional funds came in with the early discount, we'll probably put some bids out next week on some more properties. So we're excited. Going as planned.
Excellent. How's it looking in terms of wells being drilled, completed, and coming online and getting on production?
You talking about Iron Horse?
No, talking about Waypoint. So we've got those Comstock wells that we took down and have in the portfolio now. And so maybe how those look in terms of when those will begin production and begin payout. And then
thanks for clarification. Yeah, so these wells will be, what I consider to be kind of a typical package. They want the money obviously before the wells are being drilled, and so next, I think in June is when it looks like these wells will be drilled. And then, everybody may not know this, but they don't usually use the same rig. The rig they use to drill the wells is different from what they use to complete the wells. So they'll come back after drilling some more wells and then complete all the wells at the same time. So that's looking like an October event right now, and that'll be pretty typical of some of the packages. The wells will be drilled pretty quickly, but they probably won't come on for 4 or 5 months. And so if those wells get completed in October, they'll probably be on production in late November, early December, which will give us a distribution hopefully in January. I would say that's going to be a very typical well. Some might come on sooner, but most of them will be that type of time frame.
Yeah. So when we say distributions are going to start in January, those are going to be light, just like Iron Horse, came on. First distribution was very small. Iron Horse, that first distribution was just based on one well and 1 month of production back in December of last year. It'll kind of be the same thing this year, where we are targeting a January distribution, but that will be from the fringe where there are a couple wells that are either already drilled. I know, Mark, we were looking at a couple that have already started drilling, correct? But yet to be
That's
seen
correct.
if we bid on or acquire those. But when we look at the entire portfolio, we will likely have some that are on production in Q4, and we will likely have something to distribute in January of 2027, which will kick off monthly distributions. But of course, those will ramp tremendously in Q1 and Q2 of next year as more and more of these wells that are being drilled this year come online. With that, maybe we can pop over to Let's see, Joshua's question. Big picture question. Read a lot about private equity coming into oil. Have you seen a large increase in competition from that? And do you see any trend changes in new drilling? I know we've talked about this in the past, but about the big names not necessarily doing a lot of CapEx the last several years, or at least being pretty measured in their drilling.
So I wouldn't say that there's a loss of capital in the business. It's just a switch of where it's coming from. So yeah, to that point, the big private equity groups are not putting as much in as possible. But just as an example, at this conference I was at, there's a lot of small funds just like us at this conference, and a bunch of family offices are starting to get into the business as well. So looks like there's still plenty of capital, and there'll be plenty of competition. It's just not. It's just from a new group, and we're certainly a new group as well. So I just had lunch today with a group that does the same thing that we do, and we're talking about sharing some deal flow. So there'll be a lot of competition, but from our standpoint, it's friendly, and hopefully we can do business with some of them.
Yeah, and I think that that speaks to capitalism, right? It's like
You bet.
when a certain capital source pulls back, the market is efficient, and obviously the vacuum gets filled. You've been in the business for 35 years. I mean, can you kind of walk us through big picture? I think this would be kind of an interesting conversation point for investors to hear, you know, how the industry has evolved. I know that there were two big price shocks to the oil and gas industry, both in 2016 and 2020. But if you kind of want to walk us through those decades that you've spent in the business, and what the capital flows have looked like over those 30, 35 years that you've been in the business.
Well, sure, sure. Of course, in the beginning, when I got into business, there was a lot of really big companies, and everything was just dominated by the Exxons and the Chevrons of the world. And what changed significantly is when the shale plays came about. And so that was, in the early 2000s, George Mitchell, the Barnett Shale up in the Dallas Fort Worth area, and a lot of little companies started to get into that game, and mainly because it was easy to drill the wells. They were onshore, they weren't offshore. You didn't have to go to some other country to find anything. And as we started developing these unconventional plays, they're called, it became very much like a mining operation. So very little risk. And so that brought a whole lot of capital back into the business, because you could spend $100 million and drill, however many wells, maybe that's 10 or 20 wells, and none of them would be dry holes. And that's, kind of when the IDC, everybody caught on to the IDC kind of tax benefit, that was originally put there for people to explore and invest in very high risk things. But that law has stayed in place, and very fortunate for us. So it allows us to participate in something that's not quite so risky as it used to be, and still get the tax breaks. But a lot of money left the business during COVID. But once again, all that did was, I think, just switch hands. There was a lot of international money in the oil and gas business before, or right before COVID, and they all left. A lot of the big banks got out of business as well, but there seemed to be plenty of people that have stepped back in and taken their place.
With that being said, I think that the story that's being told at the energy conferences that I've been to over the last few years is that the industry is a lot more disciplined and measured after experiencing two price shocks in the last decade. And while Trump is saying "drill, baby, drill," no one is overly exuberant to go out and overproduce.
Yeah, agreed. I haven't seen really an increase in deal flow, to be honest with you, since the prices went up. Just seems like everybody's doing what they were doing beforehand, and just
We
hoping
talked
for hoping for some type of stabilization.
Absolutely. Yeah, we talked about this yesterday. The futures markets, if you Google CME Group, is the best place to go. So if you Google WTI crude futures, you'll be able to see the strip price goes out, and 2 years from now, oil's trading at $72 a barrel, $71 a barrel, and so that's more indicative of the market than the spot price today.
Another thing I wanted to mention that's really changed over the last 20 years is the efficiency for which wells are being drilled. A offshore Gulf of Mexico well that 20,000 feet deep, used to take 2 or 3 months to drill. We're drilling wells down 10,000 feet and horizontally 4 miles inside of a 3 week period right now. So things have dramatically changed from a drilling perspective to be able to access these reserves, and that's very key in these unconventional plays because they're all horizontal. They're not vertical wells. They go down and then out, miles and miles and miles.
Hey, Paul.
Hey,
Hey,
Paul.
fellas. I
Love to
do
hear
have
what
a
you're thinking,
question.
man.
I thought of one. So maybe walk us through how you envision closing out the fund. So like who is going to want to buy either like a grouping of like 3% interest or a 10% interest and this or that? Like how do you envision like actually winding this up and selling off the different interests? Maybe walk us through that, how that looks.
So, like I said earlier, we've got around $300 million of deals in our inbox, and those are going to come and go. Some of them have already expired, but we're expecting to get access to that same number of quantity and quality of deals throughout the year. That'll probably be 4 or 5 times that size by the time the end of the year comes around in terms of how many deals we will have seen. And they're a big mixture. We've gotten some packages of 50% interest in wells, and we've gotten some packages that are 0.5% interest in wells. And so, in the beginning here, that's a very good question. We're probably going to try and get some larger percentages, and diversify into the different basins. But as we approach the end of the year and, there's maybe a lot less to deploy, we'll potentially have to put that to work in some much smaller packages or maybe, deal a deal with someone else. That's kind of how it went with Iron Horse last year. There were several wells that got swapped in and out within the last, I think, 3 or 4 days of the fund being open just to make sure, the exact amount of capital got committed. In fact, some wells got pulled out because it didn't look like they were not going to be drilled, and some new ones were put in. I envision us doing the same thing at the very end of the year. But we should have, most of our budget spent, I think, by October, November, I hope.
And that makes
I
sense.
really,
The follow on though, real quick, was just
sorry,
like
Paul, go ahead.
when we're selling off everything. I don't think I fully understand how we're going to sell these interests at the end of the 5 or 10 year period. So say we have like 40 wells in this vintage, the 2026 vintage, and some of them are a 3% interest in any particular well, and another one's like a 10% interest in another well. Just how does that actually materially get like packaged up for some sort of buyer in the P2P arena that wants that stuff?
Yeah, I'll take that, Tate. So I could list a few of them if you want to just go play around. One of them is called Efficient Markets, and the other one is Energy Domain, and then Energy Net. But that's what we'll do is in the 7 to 10 year, time frame, maybe a little earlier, maybe a little later. It's going to be dependent on pricing. So when we see, we definitely don't want to do it before 5 because we want the distributions and the cash flow. But in that kind of 7, 8, 9 year window, these wells will have produced 80, 90% of their cash flow already and will be on very low rates. And at that point, we'll package this up as a group and put it on probably one of those websites, or we might contact, a few companies that we know that, like there's one called Diversified Energy. All they do is go around and buy packages of old wells and get the operating costs down and, try and improve metrics. So there's companies out there that we could sell this to. And I feel like it would be pretty easy to sell. And we have some of that baked into the model. We think it's pretty conservative. We have a discounted, estimate of what we think we could sell it for, very conservative estimate built into the model. I don't know if you download it or not, but you can see that little bump in cash flow out there. And I think it's in year 10, Tate, or 11. I don't remember. But there are plenty of places to go sell this stuff. There's probably 20 or 30 different companies that's all they buy is packages like this. And then there's 3 or 4 different websites that we would, could potentially, hire them and have them put a package together and, sell it to the highest bidder. And of course we can put a reserve on there that, only willing to accept so much. That's a very common, very common business.
I'll also mention, Paul, that the first 2 funds that we did in the energy space were PDP focused. So the Aspen Energy Funds 1 and 2, the whole strategy was to go out and buy existing PDP. PDP stands for Proven Developed Producing. So it's a well that exists. It's like buying um, a rental property that's already got tenants in it and it's got a rent roll, and you're going in there and you're looking at it going, all right, well, I could probably raise rents a little bit, trim expenses, and I can hold this thing for the next 30 years versus us being developers where we're going out um, and building something, right? And
Yeah.
so you can think of this fund being development focused, where we're building the structure and then we're gonna lease it up and stabilize it, and then 5 years later, 7 years later, sell it to somebody who just wants to come in and optimize it and hold it for the next few decades. So it's a very healthy market on this secondary, even though that well has produced 80-90% of its useful production. It'll produce for decades. I mean, Mark, do you want to speak to how long some of these wells can produce? And the decline curve is very flat at that point. So really you're buying a cash flow stream that's very slowly decreasing over the years.
Yeah, we've got them projected to last anywhere from 40 to 60 years. And there's already been some from when the first shale plays were developed in the early 2000s that are still online and still have a long way to go. I don't think, to answer the other question, have we ever not been able to sell out? Well, that's why we've got a range in that window. So if we're sitting out there at year 7 and the prices are really low, we might not be able to sell it that year. We have to wait till year 8. And if it's, a 2-year run of bad prices, we'll wait a little longer. On the other hand, if we're sitting there in year, 8 or 9 and oil prices are up over 100, we'll probably pull the trigger and, go ahead and sell it while the markets are good.
I'll
That's
also
great.
jump
Thanks, guys.
in there. Yeah, thanks for that question, Paul.
Yep.
I'll also jump in and just say, unlike a real estate deal, that let's say was supposed to be 5 years and is going to 7. In that real estate deal, you're waiting for, let's say you put 100 grand into that deal, you're waiting to see that $100,000 back. And so you're really irritated that that deal is going longer than expected, right? Because you're waiting for that return of capital in let's say it's year 5, and the profit on that sale. Whereas this, you really have, by year 7, you've received your capital back. You're only getting, maybe a 5 to 10% distribution rate annualized at that point. And so this will be a deal that you've largely forgotten about because it'll be 7 years down into the future, and it'll just be providing a very small amount of passive income. And when the market is ripe, you might see a nice little pop where you might get 15% on capital contributed back in your pocket. And it's like, oh, that's a nice little surprise. But it's not like you're waiting for this big payout of original principal and profit like you would see in a real estate deal. So whether it sells in year 7, 8, 9, 10 is not going to, I don't want to say you don't care about it, because of course you do as an investor, but you're not waiting with bated breath like you might be on a real estate deal, if that makes sense. Good question. Thank you, Paul. Nice to see you as well. Alex was kind of asking the same question there. And I think, Mark, if you need to drop, no worries. Mark is going to be boarding a flight here. So with that, we can move on to some other stuff.
Talk to you guys later.
Okay. Thanks, Mark. Brittany, you had a few things that you wanted to just touch on the subscription agreement.
Sure. I'm just going over the subscription agreement, things that we're looking at from the IR team and operations team side to make sure that your documents are in order.
I'll cover a couple things that have popped up for me just for the recording. One is a lot of people have been asking, hey, do I need to wire funds to make the cutoff for the 10% discount? No. This is a funds initiated deadline. And so if you go to your dashboard, you can initiate funding weekdays, weekends, any hour. Like the bank doesn't have to be open for you to initiate that ACH funding. Of course, that takes 3 to 5 business days to process. Doesn't matter when those funds land in our account, as long as they were initiated before May 31st, which is a Sunday, you're good to go. If you have to wire, then you would actually have to do that weirdly today, because or if you can initiate a wire on your bank on the weekend, great. As long as it was initiated, That's what we baked into the legal documents, because last year we did a funds received deadline and we were very clear that it had to be funds received, but it caused a lot of frustration, and people were we had a few investors who were a little irritated that funds took a little longer for one reason or another, and they missed out on the discount. And so we had to do a little bit of damage control there. So this year we said, you know what, from now on, it'll be a funds initiated deadline. So that's one question that's come up a lot. Another one is, will the K1s be on time? Yes, they will be. We did the tax webinar back on Wednesday. If you haven't listened to that and you're interested in all of the little nuances of how the tax benefits work, we had Tiffany Kennedy, who is with Strong CPA. They are going to be working in very close coordination with our asset level accountants on this. They have a pre-existing relationship, the two of them, and that's why we brought in Strong CPA. Upstream OGA, Upstream Oil and Gas Accounting, which is a super original name, but great for SEO, I guess. They're a fantastic firm. They're going to be doing all of the well level accounting down to the API numbers of each well. Obviously, all the there's a very complex set of state taxes and things that goes into that, and all the joint interest billing within the fund. And then, of course, they will Strong CPA will be taking all that data and doing all of the investor K1s. So they work in close coordination, and we will absolutely get these K1s out by the deadline. So if you wanted to file, get that nice tax reduction, and then amend later with potentially some other K1s that trickle in, you're more than welcome to do that.
And if you ever want to revisit those sessions that we talked about, Tate mentioned the tax webinar. We also had a Landman webinar, last week's GP liability discussion. They are available on Apple Podcasts and Spotify at the Turbine Capital private podcast for you folks. And those links are in the chat for you.
Thanks, Brittany. Darren, great question. Assuming this fund will build out and produce similar to Iron Horse, can you speak to the completion timeline and cash flow ramp up? Absolutely. So with Iron Horse, you remember we didn't even launch that fund until October of last year, and we were buying in Q4. And so, of course, most of what we were buying was being drilled in the latter part of the year. And so that pushed our initial distribution back to Q2 of 27, which is what we had said in all of those webinars, was Q2 of 27 is when those distributions are going to start. They did start. Of course, it's just from one well. That's going to increase as of next month. We'll have a number of additional wells that are paying. They're all, most are online at this point. It's just, it takes some time between drilling, completion, production, and then, of course, depending on the company, that sale of the resource, the dollars have to go through their accounting system, and then it might be 3 months before they cut checks to their non-op partners. And so depending on the company, some companies process accounting very quickly and send those checks out. Other companies are a little slower. And so it's a little bit of a moving target in terms of how that'll ramp up, but it will ramp up. And, you're talking about the difference of 3 or 4 months on either side, either quick or slow, depending on how the portfolio builds out. So hopefully that answers your question. In terms of Iron Horse for last year, obviously we are very enthusiastic about where commodity prices are versus what we underwrote the fund at. We feel the exact same way this year. We're still getting excellent deal flow with excellent pricing. And that against the backdrop of, it looks like higher for longer commodity prices. We think $70 is kind of a new floor. We think that even the futures markets aren't really taking into account the follow-on effects of all the geopolitical issues. So we really think that it's a really good couple of years to be investing in this stuff. So for Iron Horse, the cash flow will be increasing substantially over the next few quarters. Josh is asking, can the primary operator of a well or group of well force CapEx outside of repairing issues within the current operations? Like if they want to add a new well to the area, let's see.
Basically do PDP inside of the package.
No, a new well would be outside of the scope of what we're buying into. So if we buy into a package of 3 wells, we wouldn't automatically be forced to participate in a fourth that they decide to drill. That would be in a separate. I mean, it would be a completely different deal. Repairing issues, though, is something that comes up. That's one of the things that we need to be good stewards of capital and make sure that we have contingency reserves for. Is occasionally an operator decides to put a jet pump on a well, and then all of a sudden we get a bill for a few $100,000 for our share of it. And again, this is one of the reasons why we want to be ultra diversified, is because if you own 50% of a well and you're paying, you're on the hook for 50% of any of those costs, including cost overruns. Nick's asking how many wells are expected to be drilled within this year's fund. We expect to have exposure to about 40. That can go up or down depending on how large of a chunk we're taking down on each one of these. Mark mentioned earlier, we've looked at deals that have a 50% exposure to a well. We've also looked at some that have a 0.5% exposure to a well, and we want a maximum 10% exposure to any one well within the individual portfolio. It's not mandated in our legal documents. We didn't want to legally cap ourselves at 10. If we find a really good package and it ends up being 13, we have the discretion to make an exception there. But as a general rule, we want to be under 10% exposure to any one well. That's just to build maximum diversification. It also kind of depends on how much cash we raise. We're on a really good trajectory right now. We're expecting the fund to land by the end of the year between 25 and 50 million. If by the end of Q3 we're tracking more towards that 50 mark, we might make the decision, okay, hey, we can start taking down 8-9% chunks of wells rather than needing to really stay disciplined and stay under 5 to make sure that we get the maximum diversification number. So I would say, as a general statement, we would expect to see about 40 wells in this portfolio. That's certainly what we're targeting at a bare minimum. And that'll be across 5 different basins. I think Mark has been reviewing opportunities in about 6 different basins at this time. Once there's revenue coming in, are you planning to use the contingency fund, or is that permanently part of the fund? Good question, Joshua. That is a little bit, again, a moving target. Once there's revenue coming into the fund, we don't need to hold that back quite as much. But remember, it has to be spent by December 31st in order to capture the tax benefits for 26. So we're going to be paying very close attention to our cash positions at the end of the year. This is one of the reasons why we're asking investors as much as possible, if they're going to come in before December 15th, so we have a 2-week runway in order to deploy that last minute capital. If you come to us on December 29th or 30th and you really, you just sold a house or something, and you're like, I really want to dump this in, we're not going to tell you no. We are going to have projects in the wings so that we can make sure. And remember that anything that gets drilled in Q1 of 2027 still counts for 26 tax benefits. So we have a little bit of flexibility there. As long as if we're investing in something on the very last day of this year, and it gets drilled by March, or it gets spud by March 31st of 27, it counts for 26 IDCs. So I know I'm not directly answering your question, but it's a bit of a moving target. Depends on how much revenue we have towards the end of the year and how much we think is reasonable to hold back. Once revenue is really rolling in 27, we can start to spend that down, because it just doesn't make sense for that to be sitting there as idle cash. So there will be a very small amount of IDC captured in 2027 that'll be on your 2027 K1, but we want to maximize as much as possible in 26. Thanks, Josh. Good question. Gus is asking, are contingency or idle funds waiting on bids invested? Yes, they're in a money market account. Yep. And that's in the legal documents. So we can't do anything other than have it in a money market. It says in the legal documents that the funds can be invested in a money market, but it can't be invested anywhere else. So we're making just over 3% on idle cash. Yeah. So that's one benefit of interest rates being high, I guess, is you can make 3% risk-free. Thanks, guys.
Great questions. With that, I do want to take a moment to just kind of, for the recording, ensure that I show you folks the subscription agreement, what our team is looking at, what you'll be looking at if you are ready to jump in and sign your documents. I know the documents are fairly lengthy than previous funds that we have created in the past. So I just want to take a moment to kind of address some of those big questions that we've been getting on the document side really quickly for you folks. So let me share my screen. So this is just one part of the documents. This is just the subscription portion of it. In addition to the PPM and operating agreement, this section is towards the end. So in a long list of 90-something pages or so, this kind of comes towards the end where you'll actually start to sign after you've reviewed it. I'm just going to scroll down for instance of time to actually page 29 of this section. And that's where you'll start to have your signatures. If you use the investor portal and hit click next and don't read through, this will actually be pulling you to where you'll start to sign. Most of this will be pre-populated based off of the account you've selected in the portal. So as a reminder, you could have multiple investing accounts. You can select the one you wish to invest in Waypoint Energy through. So you could have an individual, a joint, a trust, an entity. Those are just some of the example of the account types, but based off of what you select, your information will be pre-filled. You will sign here. This is just to confirm you are subscribing and participating in the Waypoint Energy Fund 2026. The key thing to note on this page is actually this section towards the bottom. The total requested commitment amount will already be pre-populated for what you have submitted, but this portion here, we do give you the option. I know last week in our GP liability discussion, Tate had mentioned that you are given the option to participate as a limited partner, but to really capture on those IDCs and those tax benefits, it's really advantageous to come in as a general partner. So we do give you that election, but this is the main thing on this page that we are looking for is that general partner or limited partner election. So just making sure that you have selected either of those boxes. A question we get a lot is, did I check the right box? If you've checked GP on this page, that will ensure that you are a GP in this deal with us. So just know that that's what we're looking at, or that's what we're referencing.
And Noel is going through every one of these sub-agreements as well. Just know that. So if you check limited partner, you'll probably get a call from Noel saying, hey, did you mean to check this?
Correct. Yeah. Yes. We are looking at every single one. One thing to note here too is that you do have your signature line. Your name will be printed here, but say you are investing with your spouse or it's a joint account, their additional signature will be coming here as well too, and they will be prompted for a signature via their email. Moving down, just common questions that we get on this page is, place of birth. Some people were born in other countries. The question around place of birth is more so, are you a U.S. citizen? Proving that you are a U.S. citizen, as we are only accepting U.S. citizens in this deal, no international investors. So if you have questions around place of birth, because maybe you were born abroad, just know that that's where that question comes from. We are just confirming your nationality and citizenship in the U.S.
Brittany, can I jump in?
Yes.
Please, TJ.
Sorry, and if your spouse is not a U.S. citizen, then please, you can fill it out as an individual. Realize we can do a transfer of interest later, but that is also a caveat. So something to think about.
Well, and that's TJ, you're married to a Brit. I'm married to an Australian, and so we know all about this. So
yeah, great call out. Thanks, TJ. Appreciate it. Okay, moving a little bit further down. This is something new that we haven't had on previous documents. Know that these are just optional. You can by all means, bypass it if you need to and you feel it's not necessary. It's in the event that you want to include maybe your spouse to get information or correspondence, if you have a legal counsel that you're wanting to include, or maybe a financial advisor. This has been a question of how can I get my financial advisor access to information that comes out about my investment? This is where you can include it here. And you can just put their name, phone number, email, and mailing address. Majority of our information will be coming out via electronic in the dashboard. So the mailing address is not necessarily required. It's more so name, phone number, and email, but these are all optional fields. And then scrolling down to general information, Exhibit B, it's a questionnaire. This one says for individuals because that's the version we're looking at, but a common question, just to reiterate again, and piggyback off of TJ, is just proving your citizenship in the United States. So if we're looking at more so Exhibit B1, item C, your citizen of country, as well as your resident for your state. This is for our blue sky filings, just confirming where your state of residency is at. And then in D, majority of our investors, if not all, will be selecting is. So the investor is a person, a US person. So again, proving that residency. This question hiccups a lot of our investors. So I just want to make sure that we are clear in understanding that this is asking if you are a US person or US citizen. So you'll want to check is. Similar questions to item E. And then only if you are part of the Turbine Capital team will you collect yes, but if you're not part of the Turbine Capital team, so all of our investors here on our call today and watching the recording, you'll actually check no for this one. And the rest are bad actor questions, just to see if you've ever been convicted, ever been questioned by the US government, the SEC.
Yeah, I'll jump in here as Haynes Boone is one of the top law firms in Houston, and they're the ones who did our documents for this, and we spent months working on these documents with them. And when I first looked at their subscription agreement, I was going, guys, this is the most robust subscription agreement I've ever seen. Are you serious? And it's because of that GP, because because everybody's coming in as GP. That's why you're seeing this bad actor disqualification questionnaire. Usually, this is stuff that just John and myself have to sign or fill out for our SEC attorneys when we're putting together other funds. So when you're wondering why you're having to fill this out when you usually don't on, let's say, a real estate deal, that's why, is because you're coming in as a general partner. And so this is disqualifying you from being a general partner in a fund. And it's an SEC rule. So anyway, that's why that's there. Yeah. We did our best to streamline it. We worked with Haynes Boone quite a bit to streamline this from its original form.
Yes. Something new also too is a W-9. This is just to ensure that we have all the information for you. It is attached here in the subscription agreements. It's more so just making sure your social security number is accurate with your name and your address. So that is for tax preparation for our controller, Mildred. And then the very bottom, and I know it's lengthy, is our privacy notice. And then the final signature pages, which would be just you or you and your spouse if you're a joint. If there's additional people we need to notice or addresses that are associated with you folks, you can place them here. And then this is the final page of which our team and Tate will countersign. So this will be a confirmation. And the last page, you won't sign this, but know that once we have countersigned your documents, a fully executed version is uploaded to your portal and accessible. And this page, it will be filled out, confirming your share class, your commitment, the units. So that's where that early investor discounts will be applied. So you'll see, not even numbers. It would be like a decimal, go down to the decimal points. And then the accepted date that we have countersigned. So just kind of walking you through those last pages.
Thanks for going through that, Brittany.
Great.
Worth mentioning while we're talking about sub-agreements and accounts and things like that, if I can share this screen, I'm logged in with my test account here. We get requests all the time to transfer interests. And so an example for Waypoint is, let's say you're coming in as an individual or as joint tenants with rights of survivorship so that you can get those active tax benefits as a GP. And we convert the partnership to limited partner. We convert everybody to limited partner in 2028. And you say, hey, I'd like to move this over into my family trust now, which you could do now and still get the active tax benefits. But let's say you wanted to move it over into an entity. In order to get ahead of that process, if you go to settings and investing accounts, you can have as many different investing accounts on your profile as you'd like. Obviously, Chuck Yeager here has a self-directed IRA. He's got Test Pilot LLC, which is the entity, and then he has Chuck Yeager as the individual. So let's say Chuck Yeager invested in Waypoint, and now he wants to move his share over into Test Pilot LLC. If he didn't have Test Pilot LLC on the portal, our team can't move it over until that account is created. So we can either take the EIN from you, take the address, take all that information from you over email or phone. But sometimes, if it's a joint account, we're asking for your spouse's social security number. It's not the cleanest way. So if you just do it yourself, you can come in here, hit new account. You would go account type, entity, or joint, or trust. And if it's an entity, it'll ask you if it's disregarded, or if it's like an S corp or a C corp, then it would file its own tax return. Usually, people are using disregarded entities. What that means is that it's an LLC and it provides liability protection, but from a tax standpoint, it just flows through to your personal return. It isn't a separate corporation that files its own taxes. And so it would be a DRE. You'd put your tax identification number, EIN, in there, and then create an account. And that makes it super easy for our team, because then when you say, hey, I want to move this over, we send you a one-page DocuSign. The team can go in and just move the share class over into that created account that's already on your dashboard here. So just figured I'd mention that. RIP Chuck. Agreed.
Perfect.
Hey, thank you everyone so much for being here. We really appreciate it. We are looking to make this the best fund we've had yet. So really excited for Waypoint 2026. Again, thank you so much. Please reach out if you have any questions. We would love to connect with you.